Why do we need trading psychology for algorithmic traders? I mean, the robot is doing all the work. Psychology is only important for manual traders. Hey, if you're new here, I'm Lisa Forex, a full-time algorithmic trader and content creator with a public track record trading on Darwinia Gold. In this video, I am going to give you 4 actionable strategies to address the myth that algorithmic traders don't need to worry about psychology. This is simply not true. We can still deviate from our trading plan, revenge trade, and blow up accounts. I would say psychology is even more important in algorithmic trading than manual trading. So when we're in a series of losing trades, there are 3 things that can happen: fight, flight, and freeze. If you fight, then that means you're most likely going to adjust the lot sizes in your robot or replace the robot with another one. Flight and freeze are actually the same in algorithmic trading because when you run away or do nothing, the robot is still trading. And if you've got it set up incorrectly, it can blow up your account. Unlike in manual trading, when you have to actively revenge trade, doing nothing has 0 result. Whereas in algorithmic trading, being inactive can be more dangerous. My first tip is structuring your money. So manual traders have at most a handful of strategies, and many people, not all, but many people have one account where they put all their money in. So I personally have about 60 or more robots trading for me at any one time, and I don't put them all in one account. So my first actionable tip is to diversify your funds. So this is how I do it. Let's pretend I have 100k in my funds. I put about 50% in my bank account, and this is safe from the brokers, so they can't touch it. The remaining funds I split up into multiple brokers. I trade with IC Markets, Go Markets, 8Cap, Pepperstone, and FBS. So each broker gets a small part of my money. And if a broker ever goes bankrupt or starts doing funny business, then I am also protected. Since I am classified as a professional trader, I get access to 500 to 1 leverage, which is why I am able to keep 50% in my own bank account. If you have lower leverage like 30 to 1, you might need to keep more money in your broker accounts to cater for the margin. So one broker that offers high leverage to the majority of users in the world is Ox Securities, and I will have a link to them below, though that is not a recommendation. So having my money spread over different accounts and different brokers serves 2 purposes. Number 1, I never lose all my money in one go. And number 2 is for trading high-risk strategies. High-risk strategies. I use a small portion of my money on high-risk strategies, currently about 5%. And when I'm talking about high-risk strategies, I mean ones that have smooth balance lines that can double an account within a relatively short period of time. Now, the dangers of these types of robots is that they can blow up accounts when you see big trends in the marketplace. And the reason I trade high-risk strategies is because the balance line is so smooth. It is very appealing when you look at these charts. So trading high-risk strategies gives me that quick dopamine boost when I see my balance line go up and up and up. And it feels exciting. There's always action happening on my high-risk strategies. Are they sustainable and profitable? That's a bit questionable, but it does scratch that itch to see the balance line go up and up and up. Now, I do have a very clear trading plan for my high-risk strategies. If the account blows up, this is part of my plan and a risk that I accept. If it does blow up, I have a 24-hour rule where I don't touch the robot for 24 hours. If it doubles, then great, I can withdraw the profits and start again. What I don't do is transfer money in when an account is about to blow up. And I have structured my money in a way that makes it very hard to do. So I don't have money set aside in my broker so the transfer takes seconds. I have to wire transfer funds from my bank account to my broker, which can take a day or 2. Now, the problem with high-risk strategies is that it is very fear-based because these strategies can blow up at any time, and it's not like they have a slow death. A short, sharp, quick move in the market can blow up an account. So you're constantly living in fear, which is not a good place to be. Yes, it does feel good when the account is slowly growing day by day, but it can be very emotional when you lose an account. which is why I only use a small part of my trading funds. Most of my funds is on low risk strategies. Low risk strategies. These are actually very hard to come by because most commercial robots are high risk for the sales because they appeal to the beginner traders with their smooth equity curves. Low risk strategies tend to be very jagged, and these are very hard on the psychology for algorithmic traders, because how do you know if the robot's edge is still valid in today's changing market? And that is the biggest challenge. Fully believing in the robot, understanding its strengths and its weaknesses in order to be confident enough to say, yes, I am in drawdown, but I know based on this and this and this that this robot will come out of drawdown. And you can't get that belief, that inner confidence and comfort knowing that what you have is gold with most commercial robots, because there is so much manipulation in the robot industry, and because most commercial robots are black box. So you don't actually know the entries, the exits, and the process of how the robot was designed, the types of market that it will cause drawdown, and what types of market it will work best in. Without that information, you are more likely to strategy hop. You'll see a robot that has good growth, jump on board as its performance starts to decline, and then when you see this, you jump on to another robot. So your own personal equity just goes down and down and down. So a while ago, I met up with some professional prop traders, and the one question I asked them was, how do you know when to stop trading a robot? And the answer they gave me was 2.5 multiplied by the historical drawdown. And I honestly don't like that answer either. So let's say you have a robot that makes on average $10,000 a year based on the past 10 years of data and has a 10K maximum drawdown. So based on the rules of the prop firm traders, you need to see a 25K drawdown before you even think about retiring the algorithm. Okay, let's play that forward a bit. You trade your strategy for a year, it makes 10K. Great. However, in year 2 and 3, it loses 25K. So that's when you take off the robot. So overall, you're down 15K, and it took you 3 years to realize this robot is no good anymore, and you're assuming that the robot's edge, which has already been working for 10 years, will continue to work for the next few years. In reality, we don't know when a strategy's edge will continue to work or when it will fail. So that's why I'm not that keen on low-risk commercial robots. Yes, they worked in the past, but when is the edge no longer effective? Do you have the confidence this robot that you paid so much money for will continue to work? Nope. Again, using these types of low-risk robots is from a fear-based psychology. So we want to switch from fear to confidence. Confidence and understanding of our system, that it works, when it will be in drawdown, and when we'll have profits. And honestly, after 2 years of seeing the edge on multiple robots decrease over time, I'm switched to using systems. And the system I chose is EA Studio because I can simulate live historical trading. I don't have a fear-based approach because I know my system has had a period of 6 months of drawdown. I know how big the drawdown is, and I know it is constantly adapting to the market because I update them every single week. That's why I don't just give the robots to my members every single week. When I do testing, I show every single step of the process. I honestly can't give them the confidence in my own system, but I do my best to be transparent about what I can do, what it can't do, so they have the right expectations. And slowly over time, hopefully they will gain that confidence. But you don't need to use EA Studio. There are other ways to get this confidence. You can find a white box robot that you can optimize yourself, or you can code up your own robots, because you can't get this confidence with black box commercial expert advisors because you ultimately don't have control. So here are 4 actionable steps in order to master your psychology with algorithmic trading. Number 1. Spread your money over multiple brokers and bank accounts. Number 2, if you like high risk strategies, then use small accounts or cent accounts. Number 3, along the lines of high-risk strategies, make it hard to transfer money when your small account is about to blow up. And number 4, for low-risk robots, get confidence however you can. Code a robot, optimize a robot, or find a system that adapts to the market so you can gain this confidence. And on the topic of adapting, if you want to learn more about my own process for constant improvement with EA Studio, then watch this video right here. Thank you. Bye.